Chapter 4, Accounting for Merchandising. So we're going to take a look at the difference between the financial statements of a service business, which we've looked at so far, to those of a merchandising business. We're going to look at the financial statements, the accounting for the sale and purchase of merchandise, freight and sales tax, and then the idea of merchandise shrinkage. So a service business versus a merchandise business. So the idea is that, remember chapter 1, a service business would be like a Starbucks or like Joe's Lawn Service. So Joe's Lawn Service, you pay for the service of Joe mowing your lawn. Or a merchandise business would be something like Walmart, where they buy and sell inventory. They don't manufacture it, they buy it and sell it. So Walmart would buy televisions from Samsung, and then Walmart would in turn sell them to you. So a service business involves providing a service to customers. That's family health care that we've been looking at before in chapter 3. So they provide health services to their customers, and they provide the service. And a merchandise business is the buying and selling of merchandise. So Home Depot. Home Depot buys tools from a manufacturer, and then they sell the tools to you at the Home Depot store. An important metric in a merchandising operation is cost of goods sold. So cost of goods sold is the cost of the merchandise that they sell. And then another important metric is gross profit. So if you take your net sales minus that cost of goods sold, you arrive at gross profit. So net sales is revenue less returns and discounts. So in Home Depot, that would be their net sales. And then from that net sales, or from the gross sales number, they subtract returns and discounts from customers. And cost of goods sold is the cost paid for the merchandise. So let's use Walmart, for instance. So say on a Samsung TV, they sell it for $400, and the cost paid for that TV was $100. That means Walmart's gross profit on that TV would be $300. So let's look at the financial statement. So what we look at for a manufacturing business is a multi-step income statement. So if we look at our first section, we see our net gross sales of $720,185, and then we subtract returns and allowances and sales discounts, and we get what's called net sales of $708,255. We subtract from that the cost of merchandise sold. And remember, cost of goods sold is the cost of the merchandise you're selling. So in Walmart's instance, that would be the cost that they pay Samsung to buy those TVs to put them on the shelf. Or the cost they pay Microsoft for the Xboxes to put on the shelf. The cost of the goods that they sold. And then you subtract the net sales from the cost of goods sold, we arrive at what's called gross profit. From gross profit, we subtract our operating expenses. So we have sales expenses and we have administrative expenses, and we arrive at a number of total operating expenses. When we subtract our gross profit from our operating expenses, we get what's called income from operations. Income from operations is our income from our net income from our main operation from our business. So for instance, in this case, Tech USA, if we want to say, well, how much money did Tech USA make off their main course of business, the tech business, you would say $77,240. And then underneath, there's other income and expense. So they did some rent revenue, they rented out some property, and they also had to pay some interest on some debt. So we get net income of $75,400. Remember, the other income and expense numbers are what's called below the line, because that's not Tech USA's main course of business. So those are broken out. Because if you're a bank or another investor, you'd say, well, how much are they making off their main business? And they would say $77,240. The other stuff underneath, the rent and interest, that's just stuff on the side. And then you arrive at net income. So the idea of the cost of goods sold There's two different types of inventory systems. We have a perpetual income system and a periodic income system, inventory system. With the periodic inventory system, every so often, which would be once a period or once a year, they would count the inventory on hand. So what would happen is over the course of the year, we would take our beginning inventory that we had starting the year. So in this case, it would be $59,700. We add up our purchases of inventory that we bought of $521,980. And from that, we subtract our purchase returns and allowances and our purchase discounts. And we get our net purchase number. And then we add freight to our cost of inventory, which is $17,400. So our net inventory purchased was $527,755. That's the cost of the inventory that we bought. So if we add that to the $59,700 we started with, we have merchandise available of $587,455. And then on December 31st, we do an inventory count. And we see that we have $62,150 of worth of inventory left out of the $587,455 that we had available. So if we had $587,455 available. We had $62,150 at the end. That means we must have used and sold $525,305. That's subtracting the $587,455 and the $62,150. So a periodic inventory system does not do the inventory counting real time. So with the periodic method, you have your inventory account, you add your purchases to the inventory account as you make them. You get a big merchandise available for sale number in your inventory. It's not until you do the count at the end of the year in which you adjust your inventory account down. So here's what our income statement would look like. So we have net sales, and then we have a rent revenue, so our total revenue comes out to be $708,855. And then our expenses be cost of merchandise sold, and then our other expenses to get to net income of $75,400. So remember, the income statement we looked at a couple steps back was called a multi-step income statement, which broke this stuff out a little bit further. This is a simple single-step income statement, which is simpler but does not give as much detail. And as for our retained earnings statement, as we've looked at before, beginning retained earnings plus net income less dividends equals ending retained earnings. Then our balance sheet, our assets, we have cash, accounts receivable we've looked at before. Merchandise inventory of $62,150. That was the ending inventory on hand when we did our inventory count a few slides back. And remember, the amount of inventory on your balance sheet is the value of the inventory you have on hand, not the value of the inventory you sold. The value of the inventory you sold goes on your income statement as an expense. And then our statement of cash flows.